Schwab Advisor Services is a proud supporter of the RIA Edge Podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com. Hi, everyone, and welcome to the RIA Edge Podcast. This podcast is, as you know, my chance to speak to the executives building the modern independent wealth management firms that are professionally managed, growing faster than the average RIA, but doing so in a way that, in our estimation anyway, is being done in a sustainable manner without sacrificing the client experience, not just simply wafting upwards on AUM market appreciation. In other words, these are firms that are growing by design and not by default, and we want to hear about their strategies, how and why they make the decisions they do, and get their views on where the wealth management industry is headed. I'm thrilled in this episode to be joined by Rob Mooney, who is the founder and CEO of Snowden Lane Partners. Rob, thanks very much for joining us.
Thanks, David. It's great to be here with you.
I think the last time we spoke to you on this podcast was probably about 4 years ago, and I know lots happened since then. But for the folks who maybe didn't hear that podcast or who aren't as familiar with Snowden Lane, could you maybe just give us the current snapshot of the firm, size, number of advisors, AUM?
Well, we're a hybrid RIA broker-dealer. We have about 150 people all in our company, 83 of whom are financial advisors. Our advisors work in teams, so we have somewhere around 40 teams. We're 12 point something and change in client assets and very profitable.
Yeah, that's great. I know you gave some financial numbers a while ago, the 30% year-on-year revenue growth, I think you've been experiencing there, which is great. Probably over total 80 million in total revenue. Does this sound accurate?
That's right. For last year, we did over 80. And since I was on this broadcast last, we were up about 4 billion in client assets and about 40% in financial advisors. I think we brought on about 26 or 27 advisors since that last meeting.
That's great. So it remains, the song remains the same. Explain to me, Snowden Lane famously tends to find most of their advisors from the wirehouse world. Is that still the case? Are you still, when you're recruiting advisors or finding teams to join you, is that still the hunting grounds in the wirehouse space?
It is correct to say that. And it's probably some of the larger non-wirehouse firms as well that aren't just the four that we all know so well. But I would say that the landscape is changing a bit because we are seeing more activity in the already independent landscape where, there are a number of firms that are gaining scale and there are a number of advisors in the independent space that are becoming disaffected with some of those firms and looking for the right environment.
So you have yet to tap the other RIAs for talent, but it might be on the agenda?
That's correct, yes.
You haven't done it yet?
No, we haven't. We have recruited from, I wouldn't call them sort of RIA competitors, but maybe smaller non-wirehouse competitors out in the marketplace. We've had some success. We actually also, we clear through Pershing and custody through Pershing, but we added Schwab this year to our custodian mix and have had great success with their resources and Schwab advisors that, again, are already independent of the wirehouses.
Mm-hmm. Great. Has anything changed in terms of the type of advisor you're looking for? I mean, we understand the environments that they're coming out of. You're looking for those sophisticated advisors that are largely in the captured wirehouse space and, bringing an independent option to them. Anything that's changed in terms of their profile, in terms of their skill set or focus or client mix, or is the formula still the same for the type of advisor you might try to recruit?
Yeah, I'd say the formula is largely the same. I mean, we're looking for largely teams-based advisors. I think we always say every great team has a finder, a minder, and a grinder. And, you can extrapolate that in almost any industry. But it's why teams perform better in our view than individual performers. And then we look for, increasingly fee-based. We are about 80% fee-based and annuitized, and 20% transactional. So that mix, and we're in the high net worth client realm. We entertain a number of ultra high net worth clients and institutions, but largely in the high net worth space.
Probably well over a dozen offices at this point. Geographically diverse.
Yes, we have a nice, we call it national footprint. We have 15 offices across the country, on the West Coast, in the middle, and on the East Coast as well. And we have a large office down in Florida. We do, 25% of our client assets are for non-U.S. resident clients. So we have an international business that, importantly, we think it's a very important component of the business, but we always wanted to have the foundation of the domestic business under our belt.
I remember when I think it was Wells Fargo or one of the wirehouses was essentially shutting down their international advising capabilities or branch. And I think Snowden Lane took some advantage of that, right? I think he found a couple of really good teams in Florida who were ex-Wells Fargo folks.
That's correct. In New York, actually. And we found some very talented advisors. And, it's still the case that a number of the larger firms are, struggling with all of the regulatory aspects of international business. They're applicable to everybody. So we deal with that too, but I think more efficiently as a high-end boutique. And I think there are great opportunities for people who become very dissatisfied with the bureaucracy at the large firms to have a better business environment in a boutique.
Yeah, let's talk a little bit about the business structure. Would you consider yourself an aggregator?
We are, David. We are a W-2 model, and we took the decision very early on that we felt that there was a larger pie to be grown by everyone working for the same company than it would be to have aggregated component companies like, people who have their own RIA or their own LLC. Mm-hmm. So we don't do 1099 and we don't do roll-up. And we think that there is still a cohesion and an integrity to a private boutique partnership where everybody's rowing in the same direction, everybody has the same equity. And we think that's really important. Every advisor who comes to Snowden Lane takes equity in the firm. And we were very, very pleased at the end of last year to be able to buy down all of our vested advisors, who are longest tenured advisors. We bought 40% of their equity at a very nice premium. And those advisors, all of them committed to stay with the firm and still have a very substantial equity stake. So it's a great aligner of interests. And we think the reason that, we like being a W-2 model and having an equity currency.
Let me ask you about that. So you had a Estancia, that was the name of the investor?
It's Estancia Capital Partners.
Partners, yeah. And they had a fund, and you essentially bought that back from them, right? So in other words, your advisors had the monetary event, right? They were able to experience this monetary event at the end of the term, right?
Correct.
Which is not something that every firm has been able to do. And I'm sure you're aware of firms that have, not gotten to that step and have gotten into some trouble.
Yeah. Well, I'll clarify. So Estancia has been our partner for a long time. They were a startup and we were a startup, and they've been just terrific partners. And we were thrilled in the course of last year to discover that they would be very supportive of us heading towards employee ownership of Snowden Lane Partners. So at the end of the year, we did, I jokingly say we did half an MBO. And people say, well, why'd you do half an MBO? And I say, well, because we couldn't afford a full MBO. But they were really gracious in enabling us to do that. And so now roughly 75% of our firm is owned by advisors, management, employees, and a few friends and family shareholders. So a really meaningful event that directionally takes us in the opposite direction to what we're seeing in the marketplace, where so much private equity is backing so many firms. And it's not to say, we love our partner and they've been great to us. But our next chapter, we think, is headed towards employee ownership. And we think that gives us better control, better alignment of incentives, and, certainly better for the employees. So we were thrilled to get that done. And then also, as you say, to be able to buy out our senior most and longest tenured advisors to a certain degree at a very nice price, I think set Snowden up for really a new beginning. It's a real new chapter for us going into this year.
Let me push on that just a little bit. Characterize a new beginning for me. Will it change your business model at all? Will it change your approach to recruiting? Will it change anything in what you do?
I think things will naturally change. Yes, we're actually evaluating our strategy right now. We think that it's important for a firm to continuously look at reinvention and where what got you here is not necessarily going to get you there in the next iteration. So we think there's a great opportunity for us to reevaluate what we're doing. But no, we haven't changed at this point. We're still a recruiting model. We intend to stay, I think, a W-2 firm for the foreseeable future, and really just build the foundation of the firm. And we feel like that has been a great differentiator for us, that there are a lot of firms that make a lot more noise. However, we have built a very solid foundation, and we're very profitable. And we feel like we have a very solid base from which to move forward.
That's great. Let's talk a little bit about the recruiting. As you say, as well as anyone, the kind of the meta story here of advisors needing to do more to justify their fees, additional services that they're bringing on board. I know you do work with a lot of high net worth and ultra high net worth families and some family office models. I'm just curious if when you're assembling your larger team out there, picking and choosing the folks you want to recruit, how much of an eye do you put towards bringing in new skill sets that maybe the rest of the team could avail themselves of? If there's like a specialist in alternatives out there, or a specialist in tax planning, or a specialist in estate planning, whatever it might be, how much cross-pollination is there from those new businesses coming into the fold that gets bled out to the other 30 some plus teams out there?
Yeah, I mean, there's a good bit of that, actually. I think alternatives is a great example, and I use that even though it's certainly everybody's kicking it around right now. But, a couple of years ago, we brought on some teams from Field Point Private who were very involved in alternatives. And we evaluated that and looked at it, and we liked it. And we thought, this is really great. And they have helped to cross-pollinate it across, all of our offices. And we're doing a lot more across different offices in alternatives now. And that's just one example. We are big believers in having advisors play a role with the other advisors. And I'll give you two examples that also happened at the end of the year. But we appointed one of our senior partners in Miami, Armando Llorena, to be on the firm's operating committee. So we now have an advisor that actually sits on the operating committee, giving great, to and fro and transparency and communication. The second thing we did is we appointed our senior partner and managing director in Bethesda, Alex Breyer, to a role in business development and recruiting across all of our offices. So now we have an advisor. He is one of our top advisors, one of the largest teams at Snowden, over $1 billion in client assets. Very talented person. And we're thrilled that he's now out asking advisors for referrals of potential recruits, which of course is the best way to get recruits. I think we've always been very firm believers at Snowden that good people attract other good people. And so, that's exactly what we want to do. So your comment about cross-pollination is important on a number of levels.
We've talked forever about, a great financial advisor is a good people person, maybe not always the best person to be running a business, and that sort of distinction there, right? Do you worry about taking some of your better advisors out in the field and elevating them to corporate decision makers and losing some of that skill out in the?
We have been very clear with those folks that their first and paramount priority is managing their practice and their team, and until such time as if they, for example, wanted to leave that practice to a completely different role. So these are hybrid roles, and I think the expectations around them, you have to understand that when you're evaluating and looking at what they're doing. But advisors have an incredibly great way of speaking to other advisors in ways that leadership and management can't. And I think even those phone calls, they're hugely important.
Yeah, advisors definitely respect other advisors.
Right.
First and foremost, that's great. You a real growth acceleration. You're on a fast growth trajectory. Can you step back a little bit maybe and think as a manager of the business, what you look at to determine when you need to add resources either here or there or wherever it might be? What are some of the metrics that you keep in mind or you keep your eye on to kind of steer the ship and make sure that you have the capacity for the growth that you're going after? Without putting too much on people's plates or having something fall off the side?
I mean, I would say the first and number one indicator is discussions with our advisors. We have 83 advisors, I think I mentioned, in the entire firm. My partners and my partner Lyle Lamoth ran U.S. Wealth Management for Merrill Lynch. Our president, Greg Franks, ran the Western Division for Lyle. They both started as advisors. I have a different background, but we are very engaged with our advisors. We have a monthly partners call where we discuss everything and anything. We have the changes that I mentioned about an advisor now on our operating committee. So to me, the number one metric is, what are we hearing from advisors? What are they interested in? What are the pain points? Where does the wheel need some oil? And that's how we approach it. And we've probably been overly disciplined on the expense side. We're very scrupulous and careful when it comes to adding people, which I think has helped us as regards to profitability. So it's not rocket science. It's really just being close and communicating with your advisors and the client relationship managers that support them.
Can you give me a sense of your management team? How big is the team that is doing the vetting of potential advisors that you are thinking about recruiting or wanting to have a conversation with? Do you spend all of your time doing that? Is that 24 hours a day? Is that your job? Or I'm sure you have a team that looks at some of these. How does it? What's the structure there look like?
By no means is that my full day, but we all engage in recruiting because recruits are the lifeblood of a recruiting model, and also, as I said before, the people that you bring into your organization, it's the most important decision that anyone makes. So we have a committee that evaluates recruits internally. We have a very robust transitions team and practice that involves a host of people. So in terms of, you mentioned vetting, it's an understanding of all of the aspects of any practice that we're bringing in. We know them front ways to back ways, and likewise they get to know us as well before anybody joins. And we always tell people, look, we never want to force anything, because if it doesn't work for you, it doesn't work for us, and it's not a good thing. So a lot of people involved in that process.
Are there, on these wirehouse teams that you're talking to, red flags, or what are some kind of must-haves that these teams must demonstrate in terms of data or numbers or anything that at least gets them past that first point of discussion?
Well, I think it's a number of elements of their business, right? Firstly, biographically, how long have they been there? What have the roles been? Are they a person that moves every so many years? And then we actually apply very specific criteria. But what is their growth rate? What is their client retention rate? What is their fee-based percentage of business versus commission business? What are their products and services? And we just go down and you evaluate every aspect of that. And within the legal requirements of the protocol for recruiting, it's an exhaustive process, but it's an important one because both sides want to get it right when you have someone join.
You don't get a sense that the wirehouse arena is picked over, in essence, right? Has that been an exhausted resource for RIAs? We've been hearing about the breakaway broker, of course, forever. And your point that there seems to be more attention kind of turning to other large RIAs in terms of recruiting. There's still plenty of, I guess, juice to be squeezed at the wirehouses. Is that?
Yeah, we think so. We think what's interesting about the wirehouses is they seem on balance perfectly happy to see their overall headcount shrink while they retain profitability. And that's the focus, right? And so I think we continue to see really high quality people looking for independence. And then, the question is, once they've decided they want to go independent, it's okay, what's the right way to do that? And as I said, I do believe that there are certain flavor of the month that become popular, and it's really important for an advisor to understand: do you want to manage a business and a company, or do you like managing your practice? And that's probably the starting point for that decision making.
Everyone is on your Form ADV.
That's correct.
Most of the back office resources are shared?
That's correct. We do, they have their direct support in the offices. They're, some people will call them sales associates. We call them client relationship managers. They have that. We have a corporate staff that supports the platform and enterprise development. And we do have certain technology. For example, we implemented Adapar last year in respect of billing and performance reporting. And that's firm-wide. We do have some variety in client relationship management tools. So it's largely a definitive tech stack with some optionality and flexibility.
And what about the investment platform? Is that something that is available for advisors in the home office if they wanted to use that, or can they still use their own investment portfolios out in the market?
They're very free to implement their own investment approach and portfolios. We do have, as I said, we have a broker dealer, which we wanted to have in order to control the menu of products and services and the pricing on those. We do most of our business through the RIA and our fee-based. And we have, over the years of bringing on teams, with virtually every team, you add some product or service or capability or know-how to your platform. And so we have a very robust investment solutions platform. It's run by a fellow named Joe Rietta in our firm.
And you mentioned the alternatives shop that you brought on board as well. Does this push for alternatives? Is there a real hunger amongst advisors and clients for these investments, or is this an asset management industry pushing the latest and greatest?
That's a great question. I don't know that I'm qualified to answer that, but I think it is demand driven. I think that a certain segment of the investing population discovered it. And once it's been discovered, I think most of these things are demand driven. If they're going to succeed, you can try to be supply driven and push product. I don't think that those things tend to really take on. And I think alternatives is it seems to me to be pretty meaningful.
Yeah, and there's all kinds of reasons for that we don't need to go into now. But this is great that you recently, I think, put together another program for retiring advisors. Is there something there that you did? And I imagine that the advisors that you find out in the wirehouses are not simply like, oh, I'm getting close to retirement, so I got to find an option here. I guess I'll go down to Rob's shop and cash my chips there. I'm sure that's not what's happening. But you did put into place a platform for some of these advisors to kind of monetize their practices at the end of their careers, right?
We think it's a great thing. We issued some press releases at the end of the year. We call it the Practice Continuation Plan. And what it does, it enables an advisor who wants to retire. Typically, that would be someone who's been with us for a while. They raise their hand, and that triggers a 5-year process. But at the beginning of that process, we're able to monetize up to 30% of that advisor's book, plus give them an acceleration on profit sharing that's a component of our comp model. It basically gives a retiring advisor a monetization event at the time they raise their hand. And we developed this with advisors who said, I don't want to retire 100% tomorrow, but I need to go buy an apartment in Florida, and I'd like to, it'd be nice to have some monetization. So they monetize, and then they have 5 years of revenue share with the inheriting advisors. And that breaks out fairly over the 5-year period with, in the early days, the retiring advisor has a higher share. In the later days, the inheriting advisors have a higher share. It also has a death benefit. So if something, God forbid, happens to the retiring advisor, the notes associated with the upfront payment are forgiven. The family is taken care of, and, it's some peace of mind. So what essentially you have is you can recruit a relatively young advisor, and we do have a young advisor force. Most of our advisors are under the age of 50. And you tell them, you come to us, you get a very nice transition package, you work for 15, 20 years, however long, right? And you can monetize again without having to go and shop around and move your book. And you have equity along the way, which is, we think, going to reward you enormously well. And you have this program on the back end. So we feel really good about it. And we're talking to a number of advisors internally who may be joining the program.
I know we have to wrap it up here pretty soon. We're going to get the boot. But if I could just ask a philosophical question at the end here, this is a podcast around growth and RIA growth and professionally managed RIAs. What do you think, if you don't have to name any names, but what do you think most RIAs are getting wrong about growth now? Right. It seems to be everyone's on a very fast trajectory, a lot of deals being done. Is there something that RIAs, is there something that they're missing that the industry overall is largely missing? Are they kind of going down a wrong path, or how would you characterize the industry at this point?
It's hard for us for me to say, because we don't play in the RIA acquisition space. But what I will tell you, we probably will. We've had some very interesting conversations. I think the number one issue is valuation. I think that very steep valuations in that space, and I'm not sure how long that's sustainable. So that's where what I would point out.
Well, that's great. You're going to let us know that your first RIA acquisition will be.
We sure will. We sure will.
Okay, well, Rob, this has been great. I really appreciate your time. I know this has been short. We could do this for another half hour at least, but I know we're going to get the full. So thank you very much for joining us.
David, thank you. It's a pleasure to be here.
And thank you for listening to the RIA Edge Podcast. Schwab Advisor Services is a proud supporter of the RIA Edge Podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com.